Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. Welcome back. You're listening to Money on Tap, and my name is Seth Krussman.
And I'm Ben Brayshaw.
We are glad to have you aboard with us today at Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. So if you are new to Money on Tap or returning and coming back to join us for today's show, we are going to be talking about all sorts of stuff. We are all across the board here today, folks. But we promise you that in this show, you're going to have a good time. We're going to be talking about all sorts of stuff. Ben, jump in.
You got all sorts of stuff, Seth. It's all over your mind, all sorts of stuff there. My goodness gracious. How you doing this morning?
I'm good. I am really good. And it's interesting to be talking about or having the conversations that we're having or about to have and be actually excited about it, because so much of when I turn on the news or when I look at my phone, it's like, oh, geez, what are we doing? What's going to happen? Are we going to turn the economy back on? I mean, it's really hard to pay attention to the news and pull out these nuggets that we've got here today.
I know. Listening to Trump speak about opening up the economy and starting it back up, that was an interesting media 2-hour blitz of information, which I really didn't feel like I got a solid answer of what he thinks that's going to be, other than he wants it to be soon. Now, I don't know what soon is, but it seems like it's going to be coming soon. So that's how I left it. It was an interesting thing. I don't know if you saw that.
I saw the headlines. I couldn't do the 2 hours of analysis on it. I couldn't
either, so I recorded it and I watched it after the fact to zip through it. So I only had like an hour into it, but it was long, and it was. I mean, he was answering people's questions. I mean, there's a lot of people that are hurting out there. I mean, that's just clearly the case, and our hearts and prayers are with everyone who's suffering right now, because that is a big deal. And I think what I do appreciate is there's a lot of people out there that are sacrificially suffering for others. I mean, there's people, you're making the decision, like, these aren't laws, these stay-at-home orders, they're recommendations. They're not, they're not passed by our Constitution. They haven't gone through any legislative experience.
I would say yes with you on that. I hear what you're saying, but if you could have $1,000 ticket that you're like, if this isn't a law, then why am I paying this right now?
Well, people are fighting these things. The Department of Justice actually backed somebody on one ticket already. It was a church, and people are making that choice. I mean, they're saying, hey, listen, you know what? This is for the good of the world, I guess. It doesn't seem like we're going to have the hit of the millions of people dead, which is a great outcome. But we need to be careful we don't tank our economy too, which creates a whole nother sort of pain and financial trouble that would be devastating in its own right. And that's, I think, the thing that's weighing on the world right now.
Yeah, it is, and that's exactly what I was meaning when I look at my phone or I see the headlines and I'm trying to wade through this. I mean, gosh, there's so much information. It is really hard to just even pull, myself through it and stay focused on what are we doing right now to improve not only us personally, but our clients, and the conversations that need to happen in order to stay focused and look outside of kind of how we feel and are reacting in that flight or fight or freeze mode that can happen intuitively to us and instinctively to us.
Yeah, I mean, I think the one amazing positive that we have that's unlike any other scenario is the fact that we are in a society that has technology beyond anything we've ever seen before, and that is allowing a lot of people to stay at work. I mean, to really still work despite all this, being home. We couldn't have done this in any other century, decade, which is an amazing opportunity for us to keep some of the economy going, which is, kind of trying to push the positive outlook, because there's a lot of businesses that are just not functioning right now.
Yeah. Yeah. Certainly crippled for, retailers, the mall. Think of the mall. It's just not happening. Now, on the bright side, I did have a interaction with a client here this last week that was really nice to hear, and they own a restaurant. Think of that right now. If that's you and you own a restaurant, how real is what is happening in your world? Now, one of the things we did is we've kind of made it a weekly practice of ours to try to support one of our local restaurateurs or businesses, and we're not eating at the restaurant, but we're picking it up and we're bringing it home. And the conversation was really nice to hear that their business is really doing well. Like they don't have people dining in, but the community is coming around and supporting their business and buying dinner or lunch.
That's awesome. That's really awesome. That's great news. I think there's a lot of people doing that. I think people are getting more and more comfortable with the idea of takeout. I talked to somebody the other day, and they said, we're just starting to do takeout. We just weren't sure what we're dealing with here, and that's normal and to be expected. It's good to hear that people are starting to really impact, these businesses in a positive way, or at least able to. I don't mean to make it sound like people aren't, but yeah.
This is going to be a good ride. We're going to have a good time today. Part of the show, we're going to land in 10. Count them out, 10 with us. Ways that you can be using your money wisely. How can you be investing? And we've actually pulled out in last shows, like we've had a lot of coronavirus investable ideas, but this is going to get a little bit more specific into maybe the sectors that you can be going into, I think, or different ways that you can be investing right now, because that's what this show is about: is your money, and your planning, and how do we go through this time right now together.
Well, it's interesting, Seth, because the 10 ideas that we have for investing during a recessionary period. There's so much conversation about what is going on, where should my money be, and is this thing, have we hit a bottom? What do I look at right now? Where do I, so we're going to talk about this U-shaped recovery that everyone's I've been talking about U-shaped. I never thought V-shaped. I hoped for a V-shape, but is it a U? I don't know. I hope it is. I hope we have that kind of piece. But while we're maybe at the bottom of this U, if we're there, which we're going to talk about here in a second, where should I be looking at my money? What should I be doing? Should I, should we be buying airline stocks while Warren Buffett's selling them at these all-time lows? Like, those are the questions people are asking. I mean, people are asking, like, hey, should I just throw $1,000 at airline stocks? That's high risk. Buyer beware. I mean, Warren Buffett's dumping these things. What do you think? I don't know. And those are things that, would be an individual gamble. I mean, that's really where it would be. But before we jump into things, we have for you our Money in the News.
Goldman Sachs abandons its bearish outlook on the market. Near term, that's what they're saying. Stocks have bottomed, and or the bottom is in, and now they're saying it's. I mean, are they saying it's sunshine and rainbows ahead?
No, but they are saying that we have really seen the spike down, and it has locked itself in for various reasons. And I mean, they've got a lot of different pieces in here that are valid, but I think with the amount of funds and stimulus dollars, not just the U.S., I mean, all over the globe that have been poured into our economies, we're kind of locking in this kind of bottom threshold, this weight that's just kind of stopping a lot of depressionary kind of. I mean, I would say that 18,000 on the Dow after being at 29,000 is a depressionary event. But is that the bottom? I do think it is. I mean, unless we have some sort of major spin-off, Seth, I don't know where you stand on this, but I'm like, unless coronavirus mutates at a level that we've never seen before, and we start seeing hundreds upon hundreds upon hundreds of thousands of deaths, and we can't control this thing, I think the bottom is in. What do you think?
It's an interesting question. I like what they're saying. I want to grab this and say, yeah, I'm with you on this. I think we're going to get to a couple of pieces that in some articles here in a little bit that kind of recap this this bottom or the what is going on in the market and why. But I do think we're going to have another test here. I think that March 23rd is maybe we're not going to get quite that low. I have quite a bit of cash on the sidelines right now looking for that opportunity or waiting for that opportunity again. We don't know if we're going to get it, but I do think I just kind of think we're going to have, I don't know what you call it, but that market malaise, I guess, where people go, or fear that happens not more than malaise, just where people go, I don't know what's going on. And market responds to indecision or not knowing what's happening by going down. That's just the way the market responds to we don't know. And so anyways, I think we're probably not going to go below those March 23rds again, but I think we're going to get another retest here in the short term.
Yeah, I think we could test those bottoms. I think we could really see those numbers. I think we could see 18, 19,000 on the Dow again. I just don't think we push through 18. I mean, I really don't. Do we see 17 and zip right back up at like 17.9 or something, and everyone says, "What the heck's going on?"
Yeah,
I think we could see
that's
that.
More like it. Yeah,
I think we could see that, but I don't think. But I think this, a bottom is kind of this very, they basically we draw lines right across graphs and charts, and we say, all right, well, here's some thresholds of pressure that we can withstand. These are some points when we push through here. That's unusual, and I don't think we're at a push-through point with the amount of stimulus that we've had. Honestly, with the amount of money that the Fed has been pouring or is planning on pouring into bonds that they've never bought before, even underrated bonds, that's really gonna drive a lot of strength inside a lot of the companies that we're concerned about out there. So that's I'm with Goldman on this. I think the bottom's in. I think there's a lot of concerning news. Buffett has done a huge report on a number of pieces here that have, he's sold out of all his airline stocks and all sorts of pieces. Says he's wrong, but I think that brings us into that next conversation. Warren Buffett's favorite stock market indicator hits record high, signaling a crash could be coming. What do you think about that, Seth? You had some thoughts when we chatted briefly.
Yeah, so first of all, this is like what is Warren talking about? And actually, when you were asking me if I was listening to Trump's address, I spent more time listening to Warren Buffett this last week than I did anybody else. Really, I love watching him. He's incredible to bring the experience that he has and the tools that he has to the table, and he is getting much older, and that's interesting to watch him put things in perspective for us. So what is this indicator? First of all, it's basically this. It's the Buffett so-called Buffett Indicator. It takes the combined market capitalization of a country's publicly traded stocks and divides it by the quarterly gross domestic product. So GDP, right? And getting those numbers in this last week, this gives us the ability to get the perspective of where are we at in terms of this indicator. So GDP has suffered greatly and probably going to suffer even more in this next quarter is what we expect to see. And with the market where it is, it's understandable that the indicator is kind of off the charts. Now, I would say this is one of the things that's interesting to me is given this Buffett indicator, if you're to look back historically on what has Buffett done in regards to this, he stays invested. He doesn't leave the market. He doesn't like step outside the market because the indicator goes off. He just says, "Oh, that's interesting. Now, how do I invest?"
Yeah, I think it's kind of like, hey, if the market's oversold, then I need to look for the things that are undersold in the market. And I think that's where he's utilizing that indicator, which is highly important to understand what he's doing there.
Yeah, and that's where we're going to head. Hey, you guys, have you called us yet? Because you can at 855-226-8551. You can also reach out to us at info@yourmoneyontap.com. Your retirement is one of the most important things that you have on your plate in your life. There's lots of events that happen in your finances. One of those might be buying a house. That's a huge deal. One of the other ones is your retirement, and even maybe more of a big deal than buying the house. All of these things come together, though, in what we call three-dimensional investing. And this is taking a look at you, putting you as the most important person in the room, and how all of these pieces come together to create what you would like to do in your life, retirement being part of those. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We'd love to have a conversation with you, even if it means that we don't have to manage your money, folks. This is important that you have conversations with qualified people to help you make decisions of what you need to do. That's why we're here today, to help you. Pick up the phone, give us a call. We'd love to talk to you and help you out. So why did I drop that little tidbit in there right now? Because we're going to talk about target date funds. And this is
very timely, very, very timely, Seth.
Yes, it's juicy, right? I can't not talk about this.
Well, with the target date fund scenario, we have been talking about this on this show for years. I mean, the lawsuits around target date funds, the management piece that people don't understand, all the different stuff. And target date funds, this article coming out of Market Watch, it's interesting. Target date funds are failing those in the cusp of retirement. Okay. Now, this is by Howard Gold. He says, market sell-off underscores how having 50% in stocks is too risky for people who are retiring now. I think with a target date fund scenario is you don't have a real understanding of the underlying assets well. You're just saying, hey, listen, I want to retire at this date. Take care of me. Have me there. There's this kind of good feeling of assurance, Seth. Like you feel like, oh, I'm going to be all set. And people just lost a ton of money. And they're upset. They're very, very upset. And with 73 million baby boomers, okay, that are going to be hurt through this, who were born between 1946 and 1964. So half about them are retired. We got another half coming, and then there's a huge group of people right behind them that are going to be retiring. And this is just destroying. I mean, we've had like 3 or 4 major bear events in the last 20 years, and we're just killing the ability for people to find returns inside this. And you and I have talked about this on the show repetitively about how, not only do we have 120 million Americans between who's retired and who's going to be retired in the next 20 years, but we have a massive market sell-off just probably from those people trying to grab their assets as they sell out, which is only amplified by market downturn. Because if dividend companies aren't paying dividends, we're seeing dividends be shut off. We're seeing all sorts of things happening. And if those dividends get shut off, the person has to create their income, and they're creating the income from a smaller amount of money, not the same amount of money. That's a devastating concept and thing to deal with.
Yeah. One of the things that we actually are doing at Brayshaw Financial right now is during this pullback is we are pulling portfolios from these target date funds and putting them into places where they actually are able to capture an income, capture a return. And we can measure and look at those things. And if you don't have the ability yourself to do this, which I would say 99% of people that are in these target date funds do not. And so that's one of the things that you have to be able to take a look at and see, okay, how am I going to create income? Because the target date fund isn't doing that. What a target date fund, why you're feeling that I have somebody looking out for me, kind of a peace and easy feeling around these things, is because it's kind of like the self-driving car concept, right? And that's wonderful in short periods maybe, but you really want to have the ability to reach over and grab that steering wheel in the event that something's going on that you need to take control.
Yeah, Seth, I was just talking to a client the other day. I said, you can buy dividend stocks, and as long as they keep paying the dividends and the yields are there and you're happy with the yield, I mean, you can weather storms like this a lot easier. That's just one of the things that you can do, because the value of the stock can go up and down. The value of your portfolio can go up and down. But if you're collecting a yield off of strong companies who continue to pay that yield, that's all part of the mix. Like, that's all part of the story to help, create a little bit of strength inside a portfolio in a market event like this. This is a big deal. And this is honestly probably going to amplify the amount of dividend buying that people focus on inside their portfolios. I don't know about you, but I'm really kind of thinking this is going to surge the dividend stock buying, equity buying play that we've been talking about for years on this show.
Yeah. Yeah. So I think one of the things that people don't realize in terms of these target date funds is that, and Ben, I believe you mentioned this a little bit ago, is that people are just retiring later. So, for instance, in this target date fund of, say, a 2025 target date fund, which means, hey, we're retired in 2025. How much equity or what's the percentage of stocks that you should theoretically have in there to be successful in that retirement? The more stocks you have, the more volatility you have, and that's not what historically is a good solution for somebody in retirement. So they're going to increase the bond exposure in these over time, and so they're going to they call it a glide path. As you are younger, you're going to have more equities. As you're closer to retirement, you're going to have more bonds. But what they're seeing inside under the hood is that these have roughly a 60-40 exposure, which is 60% equity, 40% bonds, and that would be what that portfolio looks like under the hood, which potentially is far too much exposure into the equity side or the volatility side as somebody's in a retirement corridor. That's the time frame that people really need to have pulled off parts and pieces and created a better solution to income. That's what it is. How do you get a better solution to income, hedge inflation, have opportunities still down the road? And it isn't a set it, forget it. That's just not the way that it works. These are, I think, really ultimately the design for these are a very temporary solution for people in terms of their retirement and kind of a placeholder. If you don't have somebody really working with you on your finances and in your planning for the moment. And that's fine for a momentary type of a solution, but ultimately, big long term, this is not what you want to be doing. Not a recommendation. So you can reach us at 855-226-8551 or info@yourmoneyontap.com. Reach out to us, give us a call. We'd love to help you answer some of these questions, because we know we're just talking here about stuff that we talk about all the time. If you're dropping into a conversation with us, you're like, "Oh my gosh, what are these guys saying right now?" We're here to help. Okay, we're just going to touch on some of the things that we think are important for you to be paying attention to, really, because you need to give us a call, and we need to find a solution and get you to a place where you're confident that the steps that you're taking today are going to be successful for you down the road. This is no joke, folks. This is your retirement. This is your hard work that you need to have a solution for, and know you're going to be okay. Stocks are recovering, okay? Stocks are recovering while the economy collapses. Mentioned this a little bit ago. And actually, this will make more sense than you think. That's the other tag here.
Well, Seth, I was letting you go, and you know what? There's a lot of truth in everything you said, but I wanted you to really get that out. And I'm going to take this from you. Okay, stocks are recovering. Yeah, I will. So, the thing is that why are stocks recovering? Why have we had this huge surge? Why is there, why is the bond market recovering, or in some cases almost fully recovered? Why did we have this huge bounce down and then we're 50% the way back up? And there's just a lot of really crazy movement around this. And honestly, it has to do with all the stimulus money that is being driven throughout the world. I mean, we've created some real rigidity in the bottom here. There's some estimates that may exceed $8 trillion by the time it's all said and done. That is an unfathomable number to put any sort of computation around how that impacts the market. But when the Fed comes in and says, hey, listen, we're going to start buying bonds for companies that might be considered junk bonds, that's saying you're too big to fail, Carnival Cruise Lines. Those are the types of things that they're saying. I mean, they're not using those words, but that's what that means. They think. Now, I think there's a lot of lessons learned, right? Because when we had the financial crisis and AIG was going down, we took stock as a government. The government took stock as an asset. We've learned from those, even though we made money on the AIG scenario, what people realized was like, why would we own stock and be the last person to collect on a company that goes under, right?
Right.
So they said, hey, we should be buying bonds. Bonds are the ones that are going to actually allow us to be a creditor and be in front of stock, shareholders of the company and get paid first. And that's what they're doing. And that's why they're making this shift to buy the bonds. And, you look at Carnival Cruise Lines or any of these places, I mean, these ships are like $800 million ships. Like, that's a real asset. That's a real value. And with 80 million Americans still to retire in this country over the next 20 years, and cruise lines being one of the cheapest ways to go on vacation, boy, I mean, the Fed's kind of saying there's a big deal opportunity here. I mean, if they're going to buy their bonds, why wouldn't the general public, is what they're saying. And that's what the recovery is looking like. It's something that's a little crazy, but you got to watch out for that.
Yeah. So on the flip side there, the beneficiaries of the current upheaval here are, really the mega tech companies, the Amazon, the Apple, Microsoft, Facebook, Google. They make up that $5 trillion of market cap. Now, we just talked about $8 trillion. And these are companies that are so huge, so colossal, and they are really gobbling up so much of what's going on out there right now. So, you guys, that is going to do it for us in Money in the News. If you haven't already, pick up the phone, give us a call, 855-226-8551. You can also reach us at info@yourmoneyontap.com. You're listening to Money on Tap. When we come back, we are going to be talking about 10 ways that you should be investing today.
Hi, my name is Ben Brayshaw, one of the co-hosts of Money on Tap. If you have questions when it comes to your retirement and are looking for a personalized solution, contact us at Brayshaw Financial Group. In today's volatile stock market, we can help you plan to find your successful retirement solution. Am I saving enough? Am I saving into the right places? Do my investments match my appetite for risk? Do I have a tax strategy that is going to help me keep more of what I earn? How can I maximize my Social Security income? If you are like most people, you are getting closer and closer to your retirement and may be wondering if you're taking the right steps. If you're in retirement, you may be wondering, am I maximizing my income while preserving my estate and caring for my family? We talk about all things financial in what we call three-dimensional investing, putting a plan around your financial future. If you feel that now is the time to start getting the answers to some of these questions for your own situation, give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices throughout New England and across the country. We would love the opportunity to show you how we can help. There's absolutely no cost or obligation just to meet with us, and we welcome you to our office. Call us at 855-226-8551.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And we are talking about 10 ways that you should be investing today. Could be investing today. You could already be invested today. And you know what? This is a lot of fun for us because, frankly, this is amazing times to be doing what we're doing and talking about what we're talking.
Seth, this is awesome. This is some of the best. I mean, excited to be part of the essentials and be at work every day. I mean, we're very fortunate that way. I think, but this has just been an amazing experience to watch. I mean, 2008, it's a horrible thing to see the world tumble, right, financially. but it is an amazing experience to dig yourself out of something. That's part of the success of the underdog. Watching, trying to create. I use this illustration a lot with clients and people I've talked to. Creating an escalator out of this thing versus trying to climb a long stairwell makes a big difference. And, that's something that it's just really exciting. And I want to share, this is something that's been kind of on a thing. We don't give away a lot of trade secrets, but we're going to talk about 10 ways here to invest during a recessionary period and how to do this. And we've been chatting a lot about a few of them, but I'm going to jump into the first one here. Defensive stocks. Defensive stocks are a great way to focus on investing, okay? Those are the stocks that, pay your dividends, and they tend to be more cyclical during an economic downturn. They're things that you can tend to rely on, okay? Those are going to be the companies. Like I said to somebody the other day, they said, what if the whole U.S. dollar collapses and we go to a one world currency, which is a common conversation I have with a lot of people. And, what if we have globalism? What if all of this stuff just takes over and so forth? I said to him, I don't know about you, and I can't say that this is a guarantee of any sort. But if I have the money in a U.S. dollar, or I own, Procter & Gamble stock, well, I know that no matter what kind of economic downturn we have, Procter & Gamble is still going to be producing the toothpaste that people use. So no matter what conversion they make, they're going to make some sort of lateral conversion to an economic value. So if our U.S. dollar does go worthless, owning a company might actually be a better play. I don't know about you, Seth, and that's what we mean by defensive stocks. Looking at the stocks that even in these downturn trends seem to have a rally opportunity or seem to have business. Look at Walmart. Look at Home Depot. Look at the different things that people need and use.
Have you been to Home Depot?
I have. There's thousands of people in that store constantly.
Yeah. I sat in line waiting to get in there. Trying to remember. Oh, yeah. Spencer wanted to put a pull-up bar in the garage because now we work out at home.
Yes. It's pretty funny. You can get 500 people into a Home Depot, but you can't go anywhere else with 500 people.
Yeah. And while I was there, I picked up some stuff to garden with because, I got to, that's what I'm doing. Like, get me out of my head for a little bit. Go outside and work in the yard. So, what is a defensive stock? Okay, so let's talk about that for just a second. So defensive stocks, and you've mentioned exactly where we're at there, but to drill down on that, you've got utilities, you have the personal care, you have health care, and then you have kind of another section here, which is the consumer staples. And this brings me back to 2007, 2008. I was working on at a stock brokerage on the not the exchange, but I was on a kind of like a Lehman Brothers style of a stock brokerage on a phone and dialing people and selling stock, and that's what I was doing. And what I was selling was Bristol Myers Squibb, and I remember so well people laughing at me on the phone, just laughing and saying, "Are you watching what's going on in the market? Are you a moron?" I was like, yeah, I know what's going on in the market. Trust me, the Titanic, I'm right here, front row seat, folks. But Bristol Myers Squibb was at $18.
Yeah.
And it's like at $60 today. And it was paying, I think, something along the lines of like a 6-7% dividend, right? And that's what we're talking about here when we talk about these defensive stocks, because this is your utilities, this is your Verizon, this is your AT&T. I mean, are they going anywhere? No. Are you?
Yeah, no. I mean, you have to really look at the underlying purpose of the company. Is the company defensive? Is it a utility? Is it something that people are going to need and they're still going to pay for, even when the market looks horrible and the world is difficult? I mean, are you still paying your electric bill? Well, eventually it will go off. But I'm thinking about this. I think about cell phones. I think about cell phones. I got to put cell phones in a defensive stock, Seth, because
I'm with you.
I'm looking at Verizon, AT&T. I'm looking at these companies paying strong dividends. You know what? People stop paying everything first, but their cell phone bill is the one thing they don't pay. I mean, even the people who are on the street begging for money seem to have cell phones. The cell phone bills get paid. We can't be without our cell phones in today's world. That's crazy. But I would put that almost under a utility now.
I'm with you on that. And that's just a sector of where you can be putting your money today. Second up is dividend stocks. So
now we're sounding like a record player, Seth.
I know. Did I just say that?
No.
Around we go again. Yeah. Around we go again.
Folks, dividend stocks, it is just such a key component over the next 20 years. It is a focus that people need to really dig deep and understand. And I think if you put the defensive stocks and dividend paying stocks together and you start focusing on that, it's a great income yield. It's a great way to build some value and inside your portfolio.
Yeah. Hey, one of the things that we have a good time doing is building these ideas out. And it's kind of, I mean, if you're picking up parts and pieces and you have a thing here or there in your portfolio, you probably don't know what that equals as far as an income. And maybe you're figuring it out. Maybe you're doing it on your own. But at our client portfolio, one of the nice things we have is just a report that shows you exactly how much you should be getting off of your whatever you own on a monthly basis. And it's nice to know what's kind of coming in the door, isn't it?
Yeah, it is. And it's, I mean, we really have to let people know, too, that, dividends are not guaranteed from companies. Companies are changing them, turning them off, lowering them, moving them up, moving them down. And moving a dividend down is not always bad for a company. Sometimes, and I've, in events like now, companies will turn off dividends just as a precautionary measure, but sometimes they turn them off to make other acquisitions to make their company stronger because they can buy out weaker organizations and really capitalize on, cornering a market, creating more value and strength. So it's important to understand dividends and why they move up and down and understand that they're not guaranteed.
And it's also, I mean, that's kind of you don't just buy a dividend stock because of the dividend, right? So you can go out and do some research and find some great dividends and great yields out there. Would I buy it? I don't know. Maybe. I mean, Carnival's one of those out there. I think they're paying like at these levels something like a 14% dividend if they pay it though, right? How
that's not going to happen. I highly doubt that. That would be ambitious.
It would. And some of these what was true 2 months ago is not true today, but what we're talking about here is, again, coming back into some really solid decision-making process and look at these things from an objective point of view and try to understand what else is going on around these. So, but these are great places. And again, the story coming down the road is people have to figure out income.
Yeah, that takes us right to the next one, Seth. I would say that annuities are a tremendously strong recessionary play.
I'm gonna battle with you on this one. I'm gonna say the next step is that they give us a call at 855-226-8551 or info@yourmoneyontap.com. That's how you can reach us because there's so many great ideas on our plate right now that we need to talk to you about. If you haven't had that discussion, thanks for letting me have that moment, Ben.
Yeah, no worries. So we have, annuities as our next round. There's a lot of different types of annuities. When it comes to dealing with recessions, people who own annuities before recessions love them during recessions, hate them during the growth phase, right? So it's a love-hate relationship. There's lots of different types of annuities. There's variable annuities, there's index annuities, there's fixed annuities. I'm just going to lean on the fixed annuities right now that are very CD-like, where you put your money in and you get a decent rate of return. It might be 2 or 3%, but it's not writing home, but it's a way of protecting your money. It might not even combat the inflationary issues, but tend to outperform some other fixed instruments. When we go into kind of the indexed or variable annuity space, usually what people are looking for is some sort of pension rider, income rider that's built into those programs, which have tons of detail, and you need to be very buyer beware. And I think one of the things I would throw out there as a disclosure, Seth, is that annuities can play a role, but they are not a huge component inside everyone's assets. Like, we have people out there that are abusing annuities, and we have people that are out there using annuities. And you need to make sure that it's the tool you use and not the abuse you experience, is the best way I can actually phrase with annuities. And number 4, which is kind of going into an offshoot of the insurance world, Seth, which I thought this was your idea, which I'm going to pass over to you.
Well, I wanted to go back on the annuity piece because sometimes we just, what do you mean by pension? Like, what do you mean by income rider? Like the fixed thing is it's guaranteed, right? Like you put the money in and you have a guarantee. That's the beauty of that fixed piece, right?
Yeah.
Okay. So tell me, what do you mean by, just quickly, briefly, what do you mean by the pension piece or that income rider piece?
Well, just creating, some the annuities with the insurance companies, they'll create some opportunity for an income program, usually guaranteed, that gives you some sort of semblance of a long-term income in retirement that will provide for you, especially in downturns. So we use these things as kind of like foundational elements. And we've talked about this over and over and over again, that foundational pieces in a portfolio create strength and rigidity when times are tough and difficult like now. So,
okay. Well, thank you. I appreciate that. So next is the Treasury bonds, right? So this is government fixed rate U.S. government debt. Okay, it's a security. It means it trades and it has volatility with it. It has a maturity range between 10 and 30 years. Sometimes they're referred to as T-bills, T-bonds. They pay semi-annual interest payments until maturity, and then that's that 10 to 30 year range. At basically face value of the bond, and that's paid to you as an owner of that. Now, in trading these, that's what is happening on the backside. We've seen the volatility happen, which happened this last month, right? They fell out of the sky, and people that are thinking that this is a guaranteed fixed thing, kind of like the CD or the indexed, or not the index, but the fixed annuity. That's not the case. Now, safer in terms of scale of volatility, yes, safer, and that's one of the places that you can go to, again, get a return. That's what you're looking for out of these. And that's your T-bill or your Treasury bond.
Yeah, I was gonna jump in, Seth, on the right after the annuity. So I'm gonna bounce back to the insurance side real quick. My number 5 is whole life insurance or fixed permanent life insurance, where you could create some opportunity of an insurance-based coverage, which would help during downtimes. I mean, right now we have health issues, we have medical issues. We got all sorts of things going on. Some of these insurance programs provide for those, but also the ability to buy into a dividend-paying asset with an insurance company on top of it. So if you're not looking for an income program, but you're looking for some kind of health coverage piece, which has all sorts of different stuff. So if you're wondering what we're talking about, we've done a number of shows on that. But they also have dividend-yielding assets that you can borrow from and so forth. So that would be, Seth, I think number 5 on my list as an opportunity.
Did I get mixed up here?
You did.
Did I get over my skis again?
Yes, you did. It's okay.
Is it okay for me to talk about municipal bonds next?
Seth, jump right in, baby, on municipal bonds.
So a municipal bond is what I have next on my list. So that's the basically a debt security. Okay, we're still in the bond debt world, issued by the state or the municipality or the county to finance its capital expenditures, including construction of highways, bridges, or schools. These are typically things in your state that you're voting on as the ballot comes through, whether to allow give money to the school to build out their gymnasiums or whatever the improvements are. We have those come through regularly, right? So. Yeah. What is the benefit of a muni bond in terms of potentially what's the benefit of a muni bond, Ben?
Well, potentially it could be tax-free for you. Now, it depends on the state in which you're in and which state you're buying. So you have to be careful of the state crossover and whether you'll be taxed federally. And then also you have to make sure, and speak with your CPA on this, but you have to make sure that the muni bonds that you buy are also AMT exempt, alternative minimum tax exempt, if that's an issue that you deal with, because ultimately, if it's not an AMT exempt bond, you're still going to end up having those bond values added, the income added back in the AMT side. So you have to be careful of that.
Now, does any of that matter if I'm buying it inside of my IRA or my 401k?
It doesn't, Seth, but ultimately, theoretically, right? We've actually gone back and forth on this, that corporate bonds produce a better yield usually than muni bonds. And we actually had done some very interesting trading inside some of our stuff where we actually sold corporate bonds that theoretically produce better yield inside a tax-deferred event where muni bonds don't create taxes. They're usually lower yield. And we actually went to the muni bond side for a short period because it was so highly oversold. We saw a better growth return inside that. And I think you remember we made that trade last month sometime. And those are things to look at. But along with muni bonds, I would say I have number 7 here, short-term bonds. Now, short-term bonds drive some interesting opportunity, as well as I think the term at which they provide liquidity is important. Now, there's a lot of debate, Seth. You and I were chatting about this. There's a lot of debate whether you own a bond or you own a bond fund. And, there's good and bad to both. Now, I've always been of the mindset that if you're really going to buy bonds, and this is just a practice that I've done, if you're really going to buy bonds and you have the control to actually look at bonds themselves, at least you could collect the yield that you bought, that you were happy with, and hold it to maturity. Assuming no default in the bond issuer, the person who said, "Hey, listen, will you lend me your money so I can, I'll pay you interest." As long as they don't default, you should be good. With a bond fund, ultimately, they're buying and selling bonds constantly. You have no rights to hold on to it forever. And so, short-term bond funds kind of add a little bit more, I think, protection in an environment like this than long-term bond funds because the interest rates are changing so dramatically. But you can get burned in all of them, so be careful. But I do think short-term bond funds do provide a little more liquidity. A little shorter term allows you to really kind of balance this market in short increments and then figure out where you're going to go long-term.
I love it. The CD is the next. Now, this has been a favorite for, everybody forever, as far as I can think back. It was really nice back in the 80s when it was paying out like a 13%, something like that. That was a wonderful time in the CD return world. CDs, if you take a look at them today, are in very, very low interest environments, and they have been since 2007. But what a CD is it's a guarantee by the certificate of deposit that as you put that money in, you put it for the period of time that you select, the 6 months, the year, the 3 years, whatever that is, they give you that return guaranteed, and that is a nice thing to see because in that guaranteed world, there's very few and far between. Hey, we are going to take a quick break. We will be back to wrap up this show with, I think we've got, 3 left? 2 left?
2 left. 2 left.
2 left. All right. You're listening to Money on Tap. And you can reach us at 855-226-8551 or info@yourmoneyontap.com. And any of these things that we're talking about right now, this is about you, your money, your retirement. It's critical. Give us a call. We want to make sure that you're on the right path and make sure that you get the advice you need to take that next step. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We'll be right back. Hi, my name is Seth Crustman, partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. One of the biggest concerns and largest expenses people face today is taxes. Without thoughtful planning, taxes can destroy future retirement dollars, eliminating the possibility of a timely retirement or dreams of what you want retirement to look like. If you're like most people, you're getting closer and closer to retirement, and you may be wondering if you're taking the right steps. Will my income be enough? Will rising taxes force me to give up my dreams? How does inflation factor into all of this? These are real concerns, and you're not alone. Putting a plan around your financial future is what we do. If you have questions when it comes to your financial security, and if you're looking for a personalized solution, contact us at Brayshaw Financial Group, 855-226-8551. It's time for you to start getting answers to your questions.
Headquartered in Bedford, New Hampshire, Brayshaw Financial has offices across the country. We'd love the opportunity to show you how we can help. There's absolutely no cost or obligation to meet with us. Call us at 855-226-8551. 855-226-8551.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We have been talking about where you can be putting your money during this uncertain times, this coronavirus times, and market has been incredibly volatile, like historically volatile. But there are some places that you can have guaranteed returns if that's what you're needing. You can have opportunity returns. You can be, hedging your portfolio. All those things included here. We are going to wrap it up with the last two. Leading us off, we are going to be talking about money market funds. Is it a fund? It's the money market, folks.
I'm not a big money market fund fan. So I put that out there to begin with. But I think when we actually break down what the money market does or what it invests in, they're buying, CDs, commercial paper, T-bills, repurchase agreements, banker acceptances. They're buying all sorts of different pieces. They're not guaranteed assets. So everyone, buyer beware. They're not guaranteed assets, and you really need to be careful. But theoretically, you're supposed to have a return in there. And I would tell you that it's safer than a mutual fund or a high-risk investment asset or equities. And if you're concerned about the market, it's a decent recessionary piece because, honestly, if the market goes down 20% and you don't make anything or you just lose a little bit in a money market fund or you go up just a little bit, it's better than taking a dive and then maybe you're looking to reinvest as an asset moving forward. Those are thoughts. Where CDs, Seth, like you have an ultimate time commitment. That could burn you too.
Yeah, lately looking at the money market funds and the CD returns, the liquidity is the factor with those money markets that you just don't have with the CDs. Yes, you can get your money out of the CDs, but you're going to pay whatever the difference is on the interest that you would have been receiving as kind of a get out of jail card with the CD. And the returns, frankly, are pretty darn close on that money market in relationship to the CDs that are out there right now. So I don't know. Why would you go CD versus money market, I guess would be the question.
Why you'd buy a money market over a CD, Seth? I think ultimately it's really about risk and time horizon. Ultimately a CD is guaranteed, FDIC, bank, all that backing. But I'm going to jump to number 10, Seth, for a matter of time here. We've got balanced funds. Now, this is interesting because, balanced funds are really meant to perform inside the returns of the highs and the lows of the stock market. We look at, different diversified portfolios and we say to ourselves, you know what, some people go all equities, some people are all bonds, and they're trying to really make the highest return they can and be the top of the market. Balanced funds are really those 60-40 or those 40-60. And when we say that, we're either talking 60% stocks or equities, as we call them, and 40% bonds, or 40% stocks and 60% bonds. I just think that in this type of environment, that could be aggressive for depending on your risk tolerance. Well, what do you think, Seth?
Yeah, I think the idea that a balanced fund is kind of an all-terrain vehicle. You're going to experience the ride that the market or the equities or the bonds are going to give you. Kind of getting yourself into, again, a diversified approach in the whole big spectrum. It's a bit of a set it, forget it kind of a mentality that can happen around that fund. But it can be, if you feel like you're overexposed or overweighted in one section or another, I think the balanced fund is not a bad play, not a bad place for you to go ahead and say, hey, we're going to ride this thing out. But right now we need some all-terrain vehicles underneath us to just kind of get through.
Yeah, exactly. It's definitely middle of the road, and you're shooting for it, but you're gonna ride that wave for sure.
Thanks for joining us today. You've been listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Also, we're in a podcast.
You can find us at any of the podcast venues out there. We appreciate the likes and the listens. We're also at Facebook at /3D Investing and Twitter at BFG_LLC. We appreciate you joining us here today, and we hope you make it a great day and a great life. Thanks for joining us with Money on Tap.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.